Hi, I'm Monika Halan, and today I'm in conversation with the best-selling author Gautam Baid, who has just come out with his next new bestseller. Gautam, thank you so much for being here today and speaking to us. I want to ask you straight out, it's an unusual format for a book. It's a personal diary, and it's your journey through this very volatile market of a few years. Will you just want to tell us why this format and what was the reason for writing this?
Sure. So I'll start with the basic inspiration for this book, where the inspiration came from. The inspiration for this book came from the response to a tweet of mine on 26th August last year. I often talk about the benefits and advantages of maintaining an investment journal on various social media platforms. And one of my followers on Twitter actually recommended to me, why don't you publish your learnings from your journal into a book? So I found that suggestion to be very helpful and interesting, and shortly thereafter I started work on this book, and it took me approximately a year to complete. I think all of us investors should inculcate this habit of maintaining an investment diary or an investment journal and record our observations, reflections and learnings from it, because I use this journal to receive a lot of valuable feedback and improve myself, both as an investor and as an individual. I use it to correct my biases, and I also learn a lot about myself and the past decisions that I took, and it also helps me avoid hindsight bias, because many times the investors fail to distinguish process from outcome. Many times we are right for the wrong reasons than what we thought about initially when buying a stock. But a journal helps us remain honest to ourselves and take the right lessons from the outcomes in investing. I've also maintained a personal archive of the media commentary and investor behavior during various episodes of market panic during the last 9 years. I purchased my journal in late 2014, and I've realized over time that human nature in the stock market has not really changed much over time, and as investors you want to focus on things that never change, which is the constant emotions of greed and fear.
So you have a physical journal?
Yes.
You don't write on the computer, you write physical pen and paper?
No, initially it was physical, but then later on what I started doing was I started taking running notes on my notepad in my mobile, and then at the end of the day I email it to myself, and then I flesh out those bullet points into a proper detailed journal entries in a Word document. And I think for me personally that is a very soothing exercise of actually this period of reflection at the end of the day on the learnings for the day.
So you go back and you read your earlier posts, especially I'm sure when it has to do with a specific stock or market value, you probably then go back and try and control F, where was that stock, and go back and...
That's a good question, and it's actually very helpful as an investor to be aware of the history of as many companies in the stock market, because leopards don't change their spots, and similarly some promoters appear to have become ethical during bull markets, but the fact is they never really change. If a promoter was bad in the past, he'll most likely remain bad in the future as well. You want to stay clear of such promoters while investing, and invest only with ethical management.
So your journey is begun on 1st Jan 2018 and ends just before that huge bloodbath of 3rd April 2020, when the Sensex touched 27,590. It's unbelievable today that just 3 years back, less than that, it was 27,590. Why are these dates, and why didn't you take the diary a few days forward to capture this drop?
So the book actually starts from 1st January 2018 and actually ends on 24th March 2020. That is when the bear market actually ended on 23rd March 2020. So,
but uske baad the big drop happened on 3rd April.
The bear market bottomed. The market levels, the Sensex hit 26,000 on 23rd March. That was the bottom level for the Sensex that year. Actually. After that is when the bull market began for the next 2 years.
Okay. So that is the reason for the 2 dates.
Yep.
Okay. So I'm just coming right into the book. You've written in the first chapter that you have to be detached from the stock market fluctuations. But isn't market timing the core part of being a stock picker? And that is one. So one is that you be detached, and then you write a little later on that you should buy and hold doesn't work, you have to buy and monitor.
Right.
So reconcile these things for us as readers.
Well, see, as India transitions from a developing country to a semi-developed country, the pace of change and the pace of disruption will only accelerate. And in this book, I've talked about how, because of our complacency and inertia as investors, our portfolios basically got decimated in 2018 and 19, because if a business model is becoming obsolete, if a business is losing relevance with its primary customers, then the terminal value, where 70 to 80% of the intrinsic value of any stock resides, that basically erodes away. So you have to keep a razor eye view on where the terminal value of the business is going.
Right.
So we always have to be very amenable to change, and that is one of the biggest things for success as an investor. Buy and hold is good in theory, but in a fast-paced changing environment and society like India, you have to also monitor where is the business keeping pace with the changing trends over time. And as long as the business keeps on executing and the management is doing all the right things in terms of capital allocation and corporate governance, you stay put. This is how multi-baggers actually happen for investors. You basically take a 2 to 3 year view to start with, and at the end of 3 years, if the future prospects continue to look good, then you hold on. You cannot, I think in my view, the days when you could take a 7 to 10 year view on a stock are long gone now. You start with a 2 to 3 year view, and then at the end of that period, you again take a 2 to 3 year view, and that is basically how you get those multi-baggers.
Right, and that's a view, again, just to clarify, will be for active stock pickers, people who are doing, say, passive investing on the index. They don't need to do this monitoring. They are riding a long escalator. So the attitudes will be very different for, say, a mutual fund investor and a direct stock picker.
Absolutely.
I would like to make that, because a lot of mutual fund investors also sometimes make this mistake of saying, let us churn the fund, but that doesn't really work, right?
For an index fund investor, buy and hold is the mantra.
Right.
For an active 24/7 investor like me, buy and monitor.
Okay, so on page 36, you're saying that the Indian government is not doing anything to soothe the markets. This is a time of huge volatility. And the US government in comparison is it the job of a government to interfere in markets? Shouldn't the markets look after themselves? Wasn't that the right attitude, that in a free market, the market sorts itself out?
Agreed.
RBI is different. Having liquidity available so that the liquidity in the system doesn't freeze is a very different thing. But soothing the stock market, I was a little surprised at that.
So what the fundamental difference between the governments in the Western world, and especially US and that of India, is that in the Western world, on every 15-20% stock market correction, because they're a capitalist country, the government steps in, the government officials step in, and they make soothing statements to soothe the market's nerve and tell them that we have your back, and they also inject fiscal stimulus aggressively. Even the Chinese government does the same. They inject a lot of fiscal stimulus into the economy.
They're paying the price of that now.
Economy.
I mean, so they printed their trillions of dollars. US did that, and lo and behold, inflation reached where it did. So interest rates have gone up. Now they're saying higher for longer. So inflation rates went from almost nothing to what, I think it touched 8 at some point.
Yes.
And India, we've had 5% went to 7%, no big deal. So we've not seen these jagged moves in policy rates or inflation, precisely because the government did not interfere.
Agreed. But then, if very massive fiscal stimulus will lead to inflation and other problems, another way the government can actually help the stock market participants is through reform measures. For example, in this book I've talked about how the corporate tax cut announcement in September 2019 was the biggest economic reform since 1991, and how that gave a big leg up to the stock market then. Right. So basically, this capital markets, because they help entrepreneurs raise capital for risk-taking activity, and that in turn helps generate employment. It's a very virtuous cycle, and so it's very important for any government to ensure that we have a very vibrant capital market in which entrepreneurs are able to raise risk capital pretty easily. That was the idea behind making that statement in the book.
Okay. And the book is mapping out the period of the biggest blowouts in the markets in recent times: ILFS, DHFL, the Yes Bank. And I remember very clearly that as these events happened, the capital market regulator went on tightening the debt fund rules, because that's where the big impact happened. Equity market investors can look after themselves, but the debt fund investors thought that they had safe products, and this whole credit rating collapse happened. So when you look back at that time, any trends which caused this was it the sins of the past of phone banking from Delhi which caused it? What happened here? And then how is it that investors know how to predict something like this up ahead?
Well, it's very difficult to predict these things upfront, but history has taught us investors that debt market induced pain always causes bigger pain in the equity market. Always. This is without exception, be it the West or be it the Indian markets. Whenever there is an issue in the debt market, it inevitably flows down to the equity market. And so it's very important to check for stress in the lending system. And one of the ways, which I've talked about in this book as well, to check stress in any lender is to check the funding rates in the debt market, especially the commercial paper market for the lender. If because the debt markets are much more efficient than the equity market in sensing out problem in any company. So because in the equity market, it's primarily driven by sentiment a lot of the times, but in the debt markets you have to open up your loan books to scrutiny. And therefore, the debt markets are much more efficient in sniffing out problems in any company.
But why did we go through this whole period of, it was one company after the other, similar kind of credit downgrades, similar kind of dodgy lending, dodgy business books. What happened in that time?
Basically, what had happened was anyways, that time India was in the middle of a deleveraging cycle, and many lenders had made many bad loans in the past. In the attempt to grow too fast and to increase their market cap, basically, in this book I also talked about that how hyper growth in the lending business is a very negative attribute, because it's very easy to give out money wholesale, but the true test of a lender is known only during a down cycle, because how good you are in your collection ability, that is what the market eventually pays a high valuation to. So look at HDFC Bank, Kotak, Bajaj Finance, promoters in India who talk about risk all the time. In the lending business, they in the end do far better than promoters who talk about growth and aggressive growth all the time. For example, RBL Bank, Spandana Spurti. Basically, in the lending business, it's better to have steady growth with good asset quality rather than chase hyper growth, because that's a recipe for eventual disaster.
How is it looking right now in terms of? So it seems that another upcycle is beginning for the Indian corporations, and I'll just come to that question in a bit. But are we going to be in that kind of problem again? Because that was a very peculiar set of circumstances of also easy money policy, the way that certain companies were favored. Are we in a similar situation anytime now, do you think?
Well, a few months back, RBI Governor Shantikanta Das had flagged the bubble forming in unsecured retail credit. And yesterday evening, we saw the announcement from the RBI increasing the risk weights for unsecured retail credit. And in my opinion, we have the best central banker in the world today in the form of RBI, headed by a very able governor. And whenever they sense any trouble brewing, they've learned from their past mistakes, and now they act very proactively before the problem actually happens.
So unsecured retail lending is basically credit cards and personal loans.
Correct.
Right. Okay. You on page 88 you mentioned that there are 3 ingredients for a bull market: low valuations, depressed corporate earnings, and loosening liquidity. Now, according to me, other than low valuations, both depressed corporate earnings and losing liquidity could be a feature in Q4, ahead, or Q1 next financial year. Is that what we are predicting now for the Indian market? Your basic investments is in India. So are we going to be in this place anytime, or are we already in it?
I think the last condition of those 3 conditions mentioned is
going to be
from next year, because based on the latest CPI data in the US, the interest rate hiking cycle is now done, dusted. And next year we'll see interest rate cuts from the Federal Reserve, and that in turn will give you loosening liquidity from very tight levels. I think next year onwards looks very positive for the equity markets, because liquidity acts like the mother's milk for a bull market. You need liquidity in order to fuel a bull market. And the best part right now is, last month in October, we had almost 17,000 crores of SIP money coming in, and that has helped sustain all this FI selling. Now, let's imagine a scenario what's going to happen once FIs also start buying in big numbers. The kind of surge you'll see in high quality stocks in India, because when FIs invest in India, they invest first and foremost in high quality growth stocks only, irrespective of valuations, because the cost of capital is so low. They are less sensitive to valuations, whereas DIIs are much more sensitive to the valuations which they pay for a stock. So I think next year onwards, if you really want to benefit from that upcoming tsunami of liquidity from FIs, you want to be positioned in the best quality, mid-cap, small-cap stocks in India.
one of the criticisms of the Indian market has been the lack of depth.
Mm-hmm.
The whole story is about one tiny part of the market. There are thousands of listed stocks. The whole story happens only in the people in the party. 190 IPOs have come to the market in this calendar year already. What do you think this means? This surge of IPOs. One, why is it happening? And two, how much, do we need large IPOs coming to the market? Because again, unless you have good valuation on stocks, the money will go to the same stocks, and the valuations, like you said, will keep going up. So just take me through this 190 IPOs plus the need for more such large IPOs coming to the market.
Right. So in this book, I've talked about how fundamentals do not decide the stock price at any given moment of time. Supply and demand does, and supply and demand in turn is driven by prevailing investor sentiment. One of the ways to gauge investor sentiment in the market is through IPOs, by analyzing the IPO market, and there are 3 stages of this IPO cycle. In stage 1, good companies come out with IPOs at reasonable valuations. In stage 2, good companies come out with IPOs at expensive valuations. And in stage 3, loss-making companies or companies with no track record come out with IPOs at ludicrous valuations, and most of such IPOs are heavily subscribed by retail investors whose surging presence in the stock market is a late cycle indicator, because very high levels of margin funding in the primary and secondary market is the typical characteristic of the final blowout phase of a bull market rally. So right now we're in stage 2, where good companies are coming out with IPOs at expensive valuations, and and this stage 2. So basically every multi-year bull market goes through 3 stages. In stage 1, which starts immediately after a bear market of low valuations, stocks across the board get revalued back to fair valuations. Like from this year, from 1st April till 12th of September, we had stage 1 of this bull market, where stocks across the board got revalued back to fair valuation. And sector rotation happens fast and furious during stage 1, because the stock market is trying to figure out which sector will lead this new bull market. So stage 1 ended on 12th September. Why do I say that? Because since 12th September, if you notice, the median stock price in the small cap index is actually negative. So the market has become much more narrower after 12th September. In stage 2 of this multi-year bull market, you have a narrow and selective rally in which select stocks and sectors with very good earnings visibility and growth do well. And selective bull markets is where you make the maximum amount of wealth. This lasts for 2 to 3 years. And in stage 3 of a multi-year bull market, you have in that stage, high quality underperforms, and junk stocks like SME stocks, micro caps, loss-making companies, stocks of shady promoters, those stocks go parabolic, and finally the bull market comes to an end.
So what is your prediction? Like, the bull market cycle began some time back. How long of a cycle do you see it continuing for?
For a multi-year bull market, you need multiple years of earnings growth, and after 2008, after 15 long years, for the first time across the board, across sectors in corporate India, you have managements coming out and saying that for the next 3 to 5 years, they are projecting revenue growth of 20% or more. Why do bear markets happen? Why did the 2018 to 2020 bear market happen? Because earnings growth collapsed.
Correct.
But if you have earnings growth, like corporate India is projecting for the next 3 to 5 years, then how can you have a bear market? In such a market, every dip and 15% dip is bought into by domestic mutual funds and PMS houses. So for the next 3 to 5 years, I think we have a very clear runway for making a lot of wealth. And bull markets is where you change your personal balance sheet and make it large in life. So make the most of a bull market to earn, make the most of a bear market to learn. That's the mantra.
Correct. Okay. So your book has, I see the emotional trauma of going through that period of Corona and the markets becoming volatile. Did you think the markets would crash the way they did, and then did you think they would recover so dramatically? Because I remember, I'm personally only a mutual fund investor. I don't do direct stocks. I don't deal with it. But even as with a hugely diversified portfolio, I remember when the markets did what they did in March. It is a very scary time, no matter how much data you have crunched. And it was a new problem. We had no idea. So just take us through some of the lessons you think investors should always keep in mind Because I remember saying at that time, so people were asking me for advice. So I of course did not sell my portfolio, and my only suggestion to them was that, are we going to go back into caves? Are we going to stop driving cars? Are we going to stop consuming stuff? If we are not, then markets will come back. So what was your mental state through that time?
It was a mental state like all other investors. In fact, in this book, if you recall my journal entry on 23rd March 2020, at the bottom of that bear market, most of us investors had become life philosophers. We were talking about the meaning of life and the meaning of living. What is the point of living as an investor? It all seemed lost. And that a bear market ends only when the last bull has capitulated. So what do I mean by the last bull capitulating? When the leaders or the blue chip stocks have to crash in order to make a durable bottom. So in this book also I've talked in the beginning that I was constantly waiting for the large cap blue chips to crash, because then only you can have a true durable bottom taking place. How does the bear market progress? I just want to walk our audience through it. Initially, stocks of shady promoters, bad promoters crash. Then stocks of small micro caps crash. Then stocks of small caps crash. Then stocks of mid caps, quality mid caps crash. And finally, large cap quality stocks also crash. So first you have bad quality crashing, then you have micro caps crashing, then you have quality small caps, then quality mid caps, and then finally quality large caps. That is when the bear market finally ends. But towards the very end, there's panic all around, and you don't know, when the bear market is going to end, and there is despair and gloom all around. So that is the ingredient for, it's very painful setup, but that's how a bear market ends.
That is what markets are about. And unless you have the stomach for this, you don't know when the next global crisis happens. So unless you have the stomach, stay away from markets if you can't stomach the volatility. Last two questions. Impact of general election results in 2024 on markets.
Again, so I always advocate being an ardent student of financial market history in order to assess the future impact of upcoming events. So in 2004, when the BJP government lost and there was a weak coalition government which came to power, Sensex immediately hit lower circuit. Within 6 months, we were again back to all-time highs on the market. When the Kargil war happened in 1999, again markets crashed. Within 6 months, again we were back to all-time highs. So these things is add as deterrents or short-term irritants for the stock market. But over the long run, as long as you get earnings growth and India keeps growing over the long run, there's nothing much to worry. Just stomach this volatility in the short run. And one very important piece of advice: avoid stocks which are very sensitive to government policy, because as it is, investing is very difficult. Don't make it more complicated by investing in politically sensitive stocks. I've talked about that in this book as well, that ahead of an upcoming election, especially in the 6 months leading up to a national election, these stocks turn very volatile, because in case there is no policy continuity,
things like PSUs, is it?
Or PSUs or stocks which are very sensitive to government policies, for example, fertilizer, oil marketing companies, etc.
Okay. And you don't think that a potential coalition government will have the power to derail the growth cycle that India? So India at the moment, the way that I like to say is we've got our ducks in a row after a very long time. Will a negative result for the present government not disrupt these ducks?
It will disrupt. It will have a short-term impact for sure for probably a few years, but we stock market investors take a 10 to 20 year view on India. See, one of the biggest learnings for me in this bear market which I learned from my seniors, was believe in the power of India and its entrepreneurs and its business ecosystem. This country is very resilient. We all show to the world how resilient we are as a country during COVID, when many of the world Western powers actually wrote us off, but we actually turned out to deal with the COVID supply shocks much more better through various supply side measures, and we also acted as a healer for the world in terms of exporting crores of vaccines to the world and playing leadership role in the world. So I think just be bullish on India, and this is a common feature of all the bigs of Dalal Street, that all of them had a relentless belief in the power of this country. That is the way to go.
That's very good to hear. So one last question on your personal CAGR, your 10-year CAGR of your own portfolio.
I've done, by God's grace, I've been very lucky to be in the right place at the right time, and it has done very, very well. It's northwards of 25 to 30% over the last 10 years. But again, when I onboard clients into my India fund or in my PMS, I always tell them that that was for a personal portfolio where you can take a lot more risk.
Correct.
When you're managing public money, when you're managing other people's money, your first and foremost emphasis is on protection of capital. I always tell clients, कम रिटर्न चलेगा बट आपका पैसा खोना नहीं है, बिकॉज इट्स अ मैटर ऑफ ग्रेट फिड्यूशियरी रिस्पॉन्सिबिलिटी। करेक्ट। तो इसलिए उस केस में नो वी लो रिटर्न चलेंगे, बट हम लोग को सॉलिड कंसिस्टेंट रिटर्न चाहिए लॉन्ग टर्म में। वॉलेटिलिटी क्लाइंट्स को ज्यादा पसंद आता नहीं, तो हमें क्वालिटी स्टॉक्स में ज्यादा फोकस करना पड़ता है।
Wonderful. Great. Good to talk to you. Thank you so much. I hope this was an interesting conversation. Thank you.
Thank you.